Good morning, my dearest little captains. Daddy has a fun one for you today. My name is Adam Livingston, and I am your #1 source for Bitcoin and Bitcoin treasury company analysis. If you want the bleeding edge alpha to guide you through the greatest wealth transfer in human history, please consider liking this video and subscribing to this channel. I try to bring you fire on the reg so you can escape your fiat masters. Remember, this is not financial advice, this is financial entertainment. Consult a licensed professional or some other little rascal boy before you come crying to me. Alright class, let's start with a quick thought experiment. Imagine you just bought a neon orange Lamborghini because obviously subtlety is for bond investors. Now picture driving that Lambo straight into BlackRock's parking lot, handing Larry Fink the only garage door opener, and saying, "Keep her safe, buddy, I trust you." That is exactly what you do when you buy IBIT instead of self-custody. Or better yet, owning a Bitcoin treasury company like MSTR or Metaplanet. You're not investing in Bitcoin, you're signing over visitation rights to your own digital offspring. ETF fans love to chirp, but it's convenient. Yeah, sure, so is pre-shredded cheese. But have you ever read the cellulose content on that bag? Convenience fees compound, friends. And spoiler alert, BlackRock's convenience fee is measured in both basis points and existential risk. Here's the dirty secret: an ETF is Wall Street cosplay. It mimics Bitcoin ownership the way a cardboard cutout mimics depth perception. The custodian holds all the keys, creation redemption relies on flawless TradFi plumbing, and if a regulator sneezes in the wrong direction, trading halts faster than a meme stock short squeeze. Meanwhile, treasury companies are shouting, "We're buying more coins than Satoshi ever mined, fight us." They lever operating cash flow most of the time, issue convertibles, and slam another 1,000 BTC into cold storage before you even find IBIT's ticker on your brokerage dashboard. So tonight's mission statement is simple: stop garage parking your Lamborghini with strangers. Either park it in your own driveway, self-custody, or hitch a ride with the lunatics who are welding rocket boosters to theirs. The ETFs, they're just parking attendants. Expensive, fragile, and one compliance memo away from losing your keys. And before you comment that it's the only way for exposure in your 401k, I am well aware of that, and we all are, so keep it zipped. Time to dissect the shiny Wall Street turtle shell they call an ETF. First layer, the legal wrapper, a Delaware statutory trust, which sounds elite until you realize Delaware also issues LLCs to pet iguanas. The trust owns the coins, you just own a claim on the trust. And the structure lives under the 33 Act, not the cushy 40 Act. So the regulatory airbags are thinner than Spirit Airlines legroom. Custody, one vault, one custodian. For IBIT, that's Coinbase. For Fidelity's FBTC, it's Fidelity Digital Assets. All keys in one proverbial sock drawer. If that drawer catches fire, every shareholder gets the same ash. Creation and redemption mechanics are cash only, meaning authorized participants wire dollars first, the sponsor later buys Bitcoin on your behalf. In a calm market, that's fine. During a panic, that lag morphs into a premium discount roller coaster that nobody wants to ride without Dramamine. Governance rights? None. This isn't corporate equity. You can't show up at the annual meeting and yell at Larry Fink about ESG or node counts. You're a silent partner, paying 25 to 40 basis points a year for the privilege of silence. Optionality? Zero. The trust cannot spin up a lightning division, launch AI analytics, or issue convertibles to buy more BTC. It just sits there, collecting fees, occasionally firing an 8K about how it just still sits there. So remember, a spot BTC is a glass display case. Pretty, convenient, and totally dependent on the museum's security system. Nice to look at, terrible if you actually want to touch the art. Now let's crack open the engine block of the corporate's Bitcoin vacuum cleaners, MSTR, Metaplanet, and the whole merry band of balance sheet berserkers. First legal form, they're plain vanilla operating corporations. Same wrapper as Apple or Ford, except the product isn't iPhones or F-150s. It's pure monetary gravity. Custody architecture, multi-sig cold storage that looks like a Bond villain set. Geographically split key shards, board-approved move windows, hardware wallets sealed in nitrogen vaults. One rogue employee can't rug this stash. It takes a quorum, a paper trail, and probably a retinal scan. Capital flywheel. These maniacs can spin up equity, straight debt, or convertible notes faster than you can say order book. Strategy floats a zero coupon convert. Cash lands Tuesday. 10,000 BTC lands Wednesday. Boom, BTC per share ratchets higher with without a margin call in sight. Metaplanets work in the same playbook in yen because apparently Tokyo wants a front row seat to hyper-Bitcoinization. Governance, actual governance, you, dear shareholder, can vote. Don't like the pace of stacking? File a proxy. Storm the AGM, replace the board with 12 cypherpunks and a dog named Sats. Try that stunt with an ETF and the compliance desk. They will escort you out before you finish tweeting. And there's a business optionality cherry on top. Every Satoshi on the balance sheet is collateral for new businesses. Lightning payments, AI-driven treasury analytics, whatever cash flow geyser they dream up next. In other words, treasury companies aren't just holding the digital gold, they're weaponizing it for shareholder upside. Picture every Bitcoin in IBIT living on a single USB stick wearing a Coinbase hoodie. The trust contracts one custodian, one vault, one attack surface. A breach, a bankruptcy, a filing, or an overeager regulator hits that custodian and every shareholder is suddenly playing musical chairs with 0 chairs. Think back to Mt. Gox. Now add a congressional subpoena and a Delaware judge who believes private keys belong in evidence lockup. The vault door stays shut while lawyers bill by the hour, and your Bitcoin exposure looks more like a vintage Beanie Baby collection. Technically valuable, functionally inaccessible. The trust charter forbids self-custody. It can't pivot to a fresh multisig without SEC sign-off, a process that moves slower than airport Wi-Fi. Meanwhile, Bitcoin still clears blocks every 10 minutes, mocking you from the chain like a friend weaving from a departing train. Treasury companies dodge this choke point. Strategy scatters keys across various institutional-grade custodians. If one facility goes dark, they reroute, sign, and move on. No single vault, no hostage situation, no courtroom camping. Key takeaways: ETFs bundle convenience, then strap it to a single custodian. One cough in that hallway and the whole structure catches the flu. Treasury companies vaccinate with redundancy, and redundancy wins every pandemic. Welcome to the plumbing aisle of a Wall Street Home Depot. Spot BTC ETFs like IBIT use a cash-only creation model. Authorized participants, think turbocharged market makers, wire plain US dollars to the sponsor at 9:30 a.m. The sponsor then moseys on over to Coinbase, buys the Bitcoin, and titles it to the trust. In normal weather, this loop hums. But picture a volatility hurricane, hash rate shock, ETF inflow stampede, China bans mining again just for the nostalgia. Coinbase liquidity thins, spreads gap, and suddenly those APs look at the math and say, nah, creation stop, redemption stop, supply and demand slam into a brick wall, and IBIT trades at a premium big enough to babysit. Meanwhile, Bitcoin itself is clearing blocks every 10 minutes, 24/7 on a settlement layer that doesn't care about New York Stock Exchange holiday hours. Your ETF share, however, is now a carnival ticket whose ride is temporarily closed for maintenance. Compare that to treasury companies. No creation queue, no AP gatekeepers. They just press the buy button, sign a multi-sig, tweet "we stacked," and move on. If markets puke, they keep stacking. If markets moon, they issue converts and really keep stacking. Bottom line, cash-only creation is fueling a rocket with a garden hose. Works until you need firepower, then you're standing on the launch pad holding a soggy nozzle. Now we leave the data center and step into the marble hall of bureaucratic roulette. Start with the SEC. Under Exchange Act Rule 15C-211, the Commission can halt trading in a security if it smells information asymmetry or market confusion. An ETF freeze takes one press release. Bitcoin itself keeps clearing blocks in blissful indifference. Next stop, OFAC. If Treasury slaps a sanctions order on Coinbase or Fidelity Digital Assets, IBIT's custodian becomes a legal crime scene. Coins stay put until a federal judge, 2 agencies, and a partridge in a pear tree sign off. During that limbo, the price of your ETF share resembles Schrodinger's cat. Maybe alive, maybe roadkill, definitely unspendable. Don't forget Congress, a late-night amendment can reclassify digital assets as systemically important, forcing trusts to add capital buffers or submit stress tests. Translation: higher costs, wider spreads, and paperwork that grows like mold on cheese. By contrast, treasury companies can live under plain vanilla corporate law. If regulators attack, the board can migrate custody to Switzerland, Bermuda, or a bunker under the Rockies. Share trading continues because the security is still an ordinary share of common stock. ETFs sit at the mercy of one regulator, one custodian, and one asset definition. Corporations diversify jurisdictional risk and can vote with their feet and their keys before Washington finishes their coffee. Let's talk about the invisible hand in the cookie jar. The trust agreements crown crowns BlackRock or Fidelity as benevolent monarchs. They can adjust the sponsor fee with a simple board vote. They decide tomorrow that idle Bitcoin should earn a lending yield, quietly rehypothecating your coins through a prime broker labyrinth. They can even bolt an ESG filter on redemptions and refuse to service addresses deemed insufficiently green. You have no share class, no proxy ballot, no quarterly call where you grill management. Your only recourse is to sell, and during a market stampede, that exit door narrows fast. Now contrast that with the corporate model. Strategy floats any controversial motion, say Bitcoin lending or Lightning monetization, and shareholders can respond. File a proxy, rally votes, replace directors if necessary. Metaplanet must answer to Tokyo Stock Exchange rules and its own investors. Governance friction is built in, sponsor autocracy is not. An ETF holder relies on managerial goodwill and SEC oversight. A treasury company shareholder relies on voting rights and the threat of activist investors armed with PowerPoint. One structure trusts a guardian, the other keeps the guardian on a leash. Now we enter the slow motion pickpocket routine. IBIT's sponsor fee is 0.25% per year. Sounds microscopic until you remember compound interest is Jupiter-sized, whether it works for you or against you. Hold raw Bitcoin for the next decade at a conservative 45% compound annual growth rate, and you 29x your purchasing power. Hold IBIT instead, and the trust quietly shares 0.25% of units every year. The sponsor has siphoned off almost a full year of gains while you slept. Roughly 1 month of price appreciation sacrificed to fees while you sleep. Treasury companies, zero mandatory custody fee. Dilution only happens when management chooses to issue equity or converts, typically to buy more coins, lifting Bitcoin per share and offsetting the hit. You're swapping strategic growth-oriented dilution for automatic parasitic fees, and only one of those builds your stack. Sponsor fees are termites, tiny, invisible, relentless. Give them a decade and they'll hollow out a chunk of your monetary mansion. While Treasury equity is busy adding new floors. Time for a stress test. We'll drive 3 18-wheelers straight at the ETF structure and see what comes out the other side. Scenario 1, custodian hack. Coinbase loses a multi-sig shard, panic headlines bloom, redemption slam shut. IBIT trades like a meme stock on a Friday afternoon, premiums hit orbit, and you hold a lottery ticket with yesterday's numbers. Meanwhile, Strategy's keys are sliced across continents. One data center burns, they sign with the backups and tweet a gif of Sailor pouring coffee. Market shrugs, shares keep moving. Scenario 2, SEC Wells notice. The commission frowns at BlackRock or Fidelity, label the disclosure gap, and hits the pause button. ETF shares freeze on every platform while lawyers assemble. A corporate issuer just files an 8K and keeps selling software or air conditioning units or whatever pays the bills. Nothing halts. Scenario 3, sponsor insolvency. One day, if BlackRock merges, spins, or face plants, the trust must petition for a successor and court-supervised asset transfer. That process measures time in quarters. If MSTR ever hypothetically changed hands, the acquirer takes the coins too. Shareholders either tender or roll, liquidity never switches off. Pattern spotted, an ETF relies on a single flawless supply chain. Break one link and the whole machine stalls. A treasury company has multiple engines, multiple exits, and shareholders who can vote to replace the driver. Resilience lives where redundancy lives. Let's lift the hood on why a share of MSTR or Metaplanet is Bitcoin with rocket boosters. Leverage without margin calls. Treasury stocks trade at 1.5x to 30x their BTC par net asset value. That multiple is market source leverage. No lender, no liquidation price. Think of it as owning a call option on every future SAT they buy, financed by other people piling into the float. Number 2, the growth flywheel. Issue zero coupon converts, buy a truckload of Bitcoin, watch Bitcoin per share rise, which justifies a higher equity valuation, which makes the next raise cheaper. Repeat until everyone is dead in an apocalypse event. This is number go up in feedback loop form. The ETF has no such reflexive engine. Number 3, optionality that compounds. Every SAT on the balance sheet can be collateral for a brand new revenue stream. Index inclusion flows, hello S&P 500, pour passive money onto that flywheel and amplify torque. Meanwhile, IBIT's greatest ambition is to just keep existing and invoice you 25 basis points for the honor. Put differently, an ETF is a static selfie. A treasury company is a live-action sequel with an unlimited budget. Bitcoin is the immortal Terminator. Strategy is the liquid metal T1000. One gives you raw exposure, the other gives you raw exposure exposure plus backstage passes, merchandising rights, and a surprise cameo from Compound optionality. Time to condense the thesis into 6 jet-fueled soundbites. Number 1, keys diversified, not siloed. 0 creation redemption fragility. No APs, no garden hose liquidity. Shares trade because the exchange is open. Bitcoin stacks because the CFO never sleeps. Number 3, actual governance. Own 100 shares of MSTR and you can storm the proxy like a digital age Viking. Own IBIT and your voting power is a strongly worded Yelp review. Number 4, operating cash flow upside. Software margins, the price you pay for a night at the Bitcoin hotel. Lightning routing fees, liquid. Real businesses shoveling fresh sats onto the pile while your ETF practices the ancient art of fee collection. Built-in Bitcoin torque, market caps trade at a multiple. That's free leverage, no broker, no margin call, just equity reflexivity doing burpees. Number 6, philosophical alignment. Sailor armed with a 250 IQ AI super assistant, and the rest wake up plotting new ways to vacuum coins off the market. BlackRock wakes up wondering whether to swap paper clips from stainless to biodegradable soy fiber. We've reached the last fork in the road, choose your vehicle wisely. Remember, I am not telling you what to do, this is not financial advice. Take me as seriously as a crack addict under a bridge eating a gas station hot dog wrapped in a sweaty sock. I put out so many qualifiers that this isn't financial advice and some people still think I'm a commander of their free will. Don't be an idiot, do your own research. Path 1, raw exposure. Buy Bitcoin, pull it off exchange, bury the seed phrase in titanium, and sleep like a medieval king whose moat runs on SHA-256. 0 middlemen, 0 free drag, pure sovereignty. Path number 2, upside on upside. Own treasury company equity, MSTR, Metaplanet, the next corporate lunatic that mortgages its lunch budget for Satoshis. You capture the full Bitcoin beta plus the equity call option, the index inclusion siphon, and whatever lightning-powered cash flow geyser they spin up next quarter. What you skip entirely, perhaps, depending on your own individualized choice, that has nothing to do with the chicken gizzard Bitcoin wizard, a glass box ETF that can be frozen by one subpoena, shaved by perpetual sponsor fees, and governed by folks who treat Bitcoin like soybean futures. Fungible, ignorable, ultimately expendable. So here's the litmus test. If you're scared of brass tacks custody, buy a hardware wallet and get over it. If you want leverage without margin calls and governance with real teeth, hitch your wagon to the treasury gladiators hustling for every single sat. Stop renting coins from BlackRock's trophy cabinet. My name is Adam Livingston. Remember, this is not financial advice. This is financial entertainment. I love you all. You are my dearest family. I have such an overwhelming amount of support from my community, and it melts my heart every day. Please leave a comment with what you'd like me to cover next. Class dismissed.